StandardAero beat consensus across the board this quarter. Let's look right at the Q2 numbers. Adjusted ETS came in at 40 cents, beating the 32 to 33 cent consensus.
Yeah, and revenue hit $1.60 billion. That beats the $1.59 billion consensus, and it represents a 4.6% year-over-year increase.
Right. And management drastically raised their full year 2026 outlook, too. They pushed adjusted EPS guidance to a range of $1.50 to $1.57.
Which completely crushes the previous $1.23 consensus.
Yeah, it really does. And they bumped revenue guidance up to a range of $6.375 billion to $6.5 billion.
But here's the crazy part. Despite that clean beat, and despite that massive guidance raise, the stock fell 3.26% in regular trading down to $30.
Yeah, and then it slid another 4% after hours to $28.80. So why the heavy sell-off if the headline numbers are this strong? I mean, is the market simply rejecting the valuation, or is there a fundamental crack under the hood that retail investors are just missing?
Well, to really understand the market's reaction, we have to look past that top-line beat. We have to examine the actual quality of these earnings.
Okay, so what did you find in the filings?
When you really dig into it, this beat is entirely driven by a massive margin inflection.
Interesting.
Yeah. I mean, for years, the overarching narrative for StandardAero has been all about their heavy, capital-intensive investments, right? Everyone was asking when those would finally start paying off.
And this quarter gave us an answer.
It did. It gave us a definitive answer.
Yeah.
Adjusted EBITDA margin hit a record 14.4%.
Wow.
Yeah, which is a full 100 basis point expansion year over year.
I mean, 100 basis points of margin expansion for an aerospace maintenance, repair, and overhaul company, an MRO, is significant. That flows straight down the income statement.
It absolutely does. Adjusted EBITDA grew 12.3% to $230 million.
Okay.
And net income surged nearly 44% to $97.3 million.
That is massive.
Right. But what you really want to pay attention to are the mechanics behind that profitability.
Okay, lay it out for us.
So it was driven by two main factors. First, the LAP and CFM56 overhaul programs out of their Dallas-Fort Worth facilities. They finally crossed into profitability.
Oh, okay. The LAPN, I mean, that is essentially the workhorse of modern commercial aviation, right?
Okay.
It powers the 737 MAX and the A320neo families. I have to imagine when an MRO takes on a completely new engine platform of that scale, the initial cash burn is just immense.
Immense is exactly the right word. The barrier to entry in aerospace MRO is just staggering.
You can't exactly just clear out a warehouse and start fixing jet engines, right?
No, you definitely can't. You have to spend hundreds of millions up front. You need specialized tooling, testing cells, and extensive technician training. Then, for the first few years, your early batches are just highly inefficient.
Because the mechanics are still figuring it out.
Yeah, they are learning the idiosyncrasies of the new platform. Teardowns take twice as long, and you basically bleed cash.
But now they're past that.
Exactly. StandardAero crossing into profitability on the LEP program means they've finally reached that volume and efficiency tipping point.
The learning curve flattens out.
Right. The learning curve flattens out, and those engines start generating actual free cash flow.
Okay, so that covers the operational leverage. But looking at the filings, there is also a major strategic shift driving these margins, specifically regarding how they are restructuring their contracts.
Yeah, this is a big one. Management intentionally eliminated $300 to $400 million in what the industry calls material pass-through revenue.
Pass-through revenue. I see this a lot in heavy industrial contracts, actually. Yeah, it's essentially when a company has to buy expensive raw materials or parts on behalf of a customer, and they bill the customer for those parts at cost, like without any markup at all.
That is the exact mechanism. In the aerospace world, airlines are notorious for negotiating these pass-through clauses.
They squeeze the MROs on parts.
Exactly. They know exactly what an OEM charges for, say, a turbine blade. And they refuse to pay StandardAero a markup on that specific part.
So StandardAero buys $1 million in parts, installs them, and bills the airline $1 million for the hardware, plus their separate fee for the labor.
Right. They book $1 million in top-line revenue for the parts, but they generate absolutely zero gross profit on it.
which optically inflates top-line revenue but acts like an anchor on the overall margin percentages.
Exactly.
It's basically like a retailer carrying a massive loss leader product line just to get people in the door.
That is a perfect analogy.
So by cutting that low to no margin pass-through revenue, their top-line growth is going to look artificially slow on paper.
And that is exactly what happened this quarter. I mean, the unadjusted revenue growth was only 4.6%.
Which doesn't look great on a screener.
Right. But when you strip out those pass-through cuts, the underlying commercial aerospace segment actually grew in the mid-teens year over year.
Oh, wow.
Yeah, they traded empty revenue calories for immediate bottom-line margin expansion.
That makes total sense.
It is a very deliberate, high-quality way to juice earnings. And, it proves management is focused on cash generation rather than just empire building their top-line numbers.
Okay, so the overall margins are hitting record highs, the strategy of shedding empty revenue is working, and the massive LAP program has exited the valley of death and is now profitable.
Right.
That makes a 7% drop in the stock price even more perplexing to me. Let's pivot to the segment-level data, because there has to be a specific operational misstep that spooked institutional sellers.
Yeah, we can isolate the issue by dividing the business into its two main reporting segments. So the first is engine services. This is their heavyweight division, and frankly, it performed flawlessly.
Clean numbers there.
Extremely clean. Revenue hit $1.405 billion, up 4% year over year. And adjusted EBITDA jumped 14.4% to $204.2 million.
With margins expanding 130 basis points to 14.5%, I mean, that segment looks entirely clean. It's capturing the volume recovery in global flight hours perfectly.
It really is. The problem lies entirely in the second segment, which is component repair services.
Ah, okay. The crack in the armor.
Yeah. On the surface, revenue grew nicely. It was up 9.2% to $194.6 million. But adjusted EBITDA actually fell 0.9% to $51.2 million.
Revenue grows by nearly 10%, but earnings contract. That implies a severe margin collapse.
It was severe. Margins in the component repair segment compressed by a massive 270 basis points. Yeah, dropping down to 26.3%. And when management was pressed on this during the call, they pointed to negative mix, work migration, and ramp-up inefficiencies.
Okay, let's translate what those terms actually mean on a factory floor. Negative mix generally means they sold a higher volume of their basic low-margin repair services, right? And fewer of their highly profitable, complex repairs.
Exactly.
But work migration and ramp-up inefficiencies, that usually points to something much more disruptive. Are they physically moving factory lines right now?
They are. And in aerospace, moving a factory line is a complete logistical nightmare.
I can imagine you aren't just moving desks and chairs.
No. You are uprooting highly calibrated CNC machines, specialized welding stations, and, non-destructive testing equipment.
Right.
Furthermore, you can't just plug these machines back in and start working. Every single piece of equipment and the new facility itself often has to be recertified by the FAA.
Oh, EHACE in Europe. Which just completely destroys your throughput. I mean, while you are waiting for an inspector to sign off on a moved machine, that machine sits idle.
Yep.
You are paying the mechanics, you are paying the lease on the building, but you aren't booking any billable repair hours.
That is the textbook definition of a ramp-up inefficiency. Management claims they are consolidating certain repair capabilities to, optimize their footprint long-term.
Which makes strategic sense.
It does. But in the short term, it creates intense friction. Throughput drops, labor costs per unit skyrocket, and you get a 270 basis point margin hit.
Wow. But is a hiccup in component repair, which, let's be honest, is the significantly smaller segment, really enough to justify a heavy sell-off?
What?
Like, is the market punishing them for execution issues on the repair side and completely ignoring the massive win in the engine services division?
The thing is, when a stock is priced for perfection, the market does not tolerate margin compression anywhere.
A fair point.
Investors hate uncertainty. And phrases like ramp-up inefficiencies suggest that management does not have complete control over the operational floor in that specific division right now.
Right.
Management expects these pressures to ease in the second half of the year as the facility moves are completed, but institutional money clearly wasn't willing to wait around to find out.
Yeah, the market is essentially punishing them for factory floor inefficiencies. But, looking at the recent capital allocation, management's answer isn't just to tweak their current factories.
No, it's not.
They seem to be buying their way out of the problem. let's look at why they just acquired Unified Turbines.
Yeah, StandardAero has been highly aggressive with its capital deployment lately. The Unified Turbines acquisition is a direct attempt to fix some of the structural margin issues in that struggling component repair segment.
Okay, how so?
Specifically, they bought the company to bring hot section repair capabilities in-house.
Ah, hot section repair. That
Yeah.
is notoriously difficult. For those who don't know, the hot section is the part of the jet engine right after the combustion chamber. The temperatures there frequently exceed the actual melting point of the metals used to build the turbine blades.
Which is just an incredible feat of engineering when you think about it.
Truly. To keep the blades from melting, they are cast as single crystals of superalloys. They're coated in advanced thermal barrier ceramics, and they even have microscopic cooling channels running right through them.
Right. So repairing those components requires specialized metallurgy, laser cladding, and vacuum brazing.
It's intense. And if an MRO doesn't have those specific, highly technical capabilities in-house, they are forced to subcontract the work to a third party.
Exactly.
And the moment you subcontract out the most complex part of the engine repair, you are handing your margin over to someone else.
Spot on. So by acquiring Unified Turbines, StandardAero captures that margin.
They bring it in-house.
Right. They take a process that was previously a cost center and turn it into a high-margin revenue generator.
It is a classic vertical integration play.
Yep. And it should drastically improve the long-term margin profile of the component repair division once it's fully integrated.
Okay, so beyond the M&A strategy, they also made a major move on the licensing front. They just signed a $180 million license expansion with a key OEM partner.
Yeah, expanding their rights across multiple turbofan and turboprop platforms.
OEM licenses are essentially the absolute lifeblood of the MRO industry, aren't they?
Oh, without a doubt. The original equipment manufacturers, companies like GE, Pratt & Whitney, or Rolls-Royce, they hold all the intellectual property.
Right.
You cannot legally repair their engines for commercial flight unless you have the approved manuals, the licensed parts, and the authorized testing protocols.
So a $180 million license expansion essentially buys StandardAero a wider economic moat.
Exactly.
But, I mean, $180 million up front is a massive check to write. What is the actual payoff timeline for an investment of that size?
Well, management laid out a very specific runway for the return on invested capital here. Because of the time it takes to tool up and actually capture market share, they only expect this license to generate $10 million in adjusted EBITDA by 2027.
$10 million. That's it.
Yeah, initially.
Yeah.
But that jumps to $20 million by 2028, and they project a $25 million annual run rate by 2029.
Okay.
And around 80% of that cash flow is expected to drop directly into the highly successful engine services segment.
So it secures a decade of high-margin work, but the immediate cash flow impact is heavily front-loaded with expense.
Very front-loaded.
That makes looking at their current liquidity even more important.
Well,
Q2 free cash flow swung to a positive $50.2 million inflow, which is a solid operational recovery.
right.
But then they immediately turned around and used that capital to repurchase 3.74 million shares for $101 million.
Yeah. And notably, they bought those shares in a private transaction specifically to clear out ownership from a GIC affiliate.
I mean, getting a major private equity player off the cap table makes sense.
It does.
It removes the overhang that can artificially suppress a stock's price because, the market isn't constantly bracing for a massive block of shares to be dumped on the open market.
Exactly.
But I have to question the overarching capital allocation tension here.
You're looking at the debt load.
I am looking at the debt load. As of this quarter, their gross long-term debt is sitting at $2.35 billion.
Yeah, it's high.
Now, I know because their earnings are growing, their leverage ratio has ticked down to 2.6 times EBITDA, which is considered manageable in the industrial sector.
Right.
But $2.35 billion is still a mountain of debt. Does it actually make sense to drop $180 million in cash on a license that won't fully pay off for 3 years, while simultaneously spending $101 million on stock buybacks?
It's a bold move.
Why not aggressively pay down that debt?
Well, management is playing a highly aggressive arbitrage game here. They are essentially betting that the internal rate of return on that OEM license, combined with the EPS accretion they get from buying back shares and, retiring that private equity overhang,
Right.
they're betting that all of that vastly outpaces the interest cost of their debt.
Ah,
Yeah.
I see.
They are projecting massive, sustained cash generation in the coming years as those LAP programs scale globally. Their models tell them they can easily service the debt while using their current free cash flow to buy future market share and boost the current stock price.
Look, it's a strategy that works perfectly in a bull market.
Definitely.
But it leaves very little margin for error. I mean, if there is a macroeconomic downturn or a sudden shock to global flight hours, that $2.35 billion debt load becomes very heavy very quickly.
Oh, absolutely.
You are locked into servicing that debt regardless of whether airlines are flying or parking their planes.
Which naturally brings us to the macroeconomic picture, right? And the end market currents that retail investors need to weigh today.
Exactly.
Yeah.
So if their strategy relies on uninterrupted growth, how do the actual end markets look right now?
The foundation remains solid,
Right.
though not spectacular across the board. Commercial aerospace is the anchor, and it was up 5.7% nominally.
Okay.
And as we discussed earlier, that number is artificially low because of the pass-through cuts.
Right.
The underlying demand there is actually growing in the mid-teens. Business aviation is also holding steady, up 5.6%. Corporate jets are still flying heavily.
The only weakness I saw was in military and helicopter revenue, which actually fell 2.6%.
Yeah.
Management tied this directly to lower flying hours. I mean, less time in the air means less wear and tear, which pushes out the maintenance intervals.
Exactly.
But they projected a low double-digit rebound in the second half of the year based on anticipated military activity. So, the end markets themselves are not flashing any major warning signs.
No, they aren't. The real risk for retail investors here isn't necessarily a collapse in the end markets. It is the valuation reality check.
Ah, okay.
Yeah. Prior to this earnings print, StandardAero was trading at a price-to-earnings ratio above 33.
33. For a software-as-a-service company, a PE of 33 is standard.
Right.
But for an industrial maintenance company that literally turns wrenches and hangers, a PE of 33 implies hypergrowth and completely flawless execution.
And that is exactly why the stock dropped 7% on an earnings beat. When a stock is priced for absolute perfection, even a slight margin miss in a subsegment.
Like that 270 basis point drop caused by factory moves?
Exactly. Even that triggers an immediate re-rating. The market isn't just pricing in today's earnings. It's pricing in years of uninterrupted high-margin execution.
Right.
The moment management admits to ramp up inefficiencies, that premium bubble bursts. Institutional investors rotate out to find safer yields.
And that valuation risk is heavily compounded by a major red flag I found buried in the SEC Form 4 filings.
The insider selling.
Yes, insider selling.
Yeah, the insider selling data here is pretty stark. CEO Russell Wayne Ford sold 40,000 shares at an average price of $31.42.
Wow.
That is a $1.26 million transaction. And it reduced his direct stake in the company by over 11% in a single move.
And it wasn't just the CEO either. Over the last 3 months, insiders across the C-suite have dumped over $5.2 million in stock.
Yeah.
I mean, if you are holding this stock, you have to ask yourself a very uncomfortable question. If the massive LAP program is finally profitable and management just raised full-year guidance so aggressively,
Right. Why are they selling?
why are the insiders cashing out right now?
It is arguably the most critical piece of the puzzle for retail investors analyzing this quarter. Now, insider selling is not always a definitive signal of impending doom.
Sure.
Executives need to diversify their portfolios. They need liquidity to pay taxes on vested options. They buy real estate. You can't assume every sale is a bet against the company.
But heavy, coordinated insider selling into a beat and raise quarter sends a very specific message.
does.
It's basically like the ship's captain quietly heading for the lifeboats while simultaneously announcing over the intercom that the ship is making record time.
That's a great way to put it.
Yeah.
When multiple insiders, including the CEO, sell a significant percentage of their holdings into a 33 times valuation multiple, it strongly suggests they believe the stock is fully valued, or perhaps even overvalued at current levels.
Yeah.
They have real-time visibility into the internal operational challenges. They know exactly how difficult and expensive it will be to fix those component repair inefficiencies.
Right.
And they know the friction involved in integrating the Unified Turbines acquisition. They're looking at the same $2.35 billion debt load we are, and they chose to take chips off the table.
So if you are looking at StandardAero today, you are staring at two conflicting realities.
Very much so.
On one hand, you have a company that delivered incredibly clean headline numbers. Overarching margins are expanding, they successfully shed hundreds of millions in empty pass-through revenue, and their largest engine overhaul programs are finally printing cash.
Right. And the strategic acquisitions and OEM licenses point to a highly lucrative future.
Exactly. But on the other hand, underneath those clean headline numbers, you have a heavily leveraged balance sheet running an aggressive capital allocation strategy.
Yep.
You have severe operational hiccups in a key repair segment that management is scrambling to fix. You have a valuation multiple that demands absolute perfection in an industry known for delays.
And most importantly, you have a C-suite that is quietly taking millions of dollars off the table while telling the public that everything is going exactly to plan.
It really leaves you with a puzzle. Will the long-term cash generation of the new OEM licenses and the newly profitable LAP programs ultimately outrun the weight of a $2.35 billion debt load and a hefty valuation multiple?
Or is the persistent insider selling the true leading indicator for where this stock is headed next?
Make sure you follow the show for your daily earnings deep dives.